I want to thank everybody for joining us for today's live webinar entitled The Ultimate Guide to Real Estate Stocks, brought to you by Millionacres. Again, I want to thank everybody for joining us. We're going to go ahead and get things kicked off here and go to the next slide, please. So before we get going, one thing I want to cover off on a little bit about who is, Millionacres, why we're talking to you folks today about what we're talking to you about. First and foremost, we are an investment subscription service dedicated to real estate investing. We're part of the Motley Fool family of companies and services. We bring to the market three core offerings: real estate winners, real estate trailblazers, and real estate mogul. Each of these solutions brings with it its own set of deliverables, and they vary from real estate stock recommendations to private placement, commercial real estate deals. The content we bring is a combination of premium content, analysis, reports, best practices, meant to satisfy the needs of novice and expert real estate investors, or even accredited investors alike. The purpose of our company is to make the world smarter, happier, and richer, and to give outstanding business and investing advice at scale. So we can go to the next slide, please. I want to introduce today's speaker, Matt Frankel. He's a REIT analyst and a senior analyst with Millionacres. He's a certified financial planner and has been a Fool.com contributor since 2012. He's graduated the University of South Carolina and Nova Southeastern University. And after a few years as a high school mathematics teacher, he decided to combine some of his loves for teaching, writing, investing to help people manage their financial lives better. So Matt, I'm going to go ahead and turn it over to you, and then I will be back on at the end to wrap us up.
All right. Thank you, Kevin. And thank you everybody else for joining. So the topic of today's webinar is investing in real estate stocks, but I realize that there are a kind of a wide variety of levels of knowledge about how the stock market works and what stocks are. So if this first slide is a little basic for you, bear with me, but some good background information. So why do we invest in stocks, and are stocks the right place for your money? So think of stocks as kind of small slices of a business. One share of stock gives you a portion of ownership in a company. The amount of ownership you have depends on the number of shares you own and the number of shares of stock there are existing, which we call shares outstanding in a company. For example, if you own 1,000 shares of a company with 1 million outstanding shares, you own 1% of that company. One very popular misconception about stocks is that the higher the stock price is, the more valuable a company is. But one big thing that all beginners should know is that you need to see how many shares total there are of a stock before you judge if a company is cheap or expensive. It's entirely possible for a stock that is $1,000 per share to be technically cheaper than a stock that's $100 per share. It depends on the portion of ownership of the company that it gives you. So one thing to know is that stocks can go up or down quite dramatically over short periods of time. If anyone's following what's going on in AMC stock today, you already know this. But over time, stocks as a whole tend to outperform most other asset classes. One of the exceptions that it doesn't tend to outperform over long periods of time is commercial real estate, which is why we're combining the stock market and commercial real estate into a discussion of real estate stocks. So the term real estate stocks, it's a very broad term, and it's really, there are a lot of stocks that are kind of gray area of what is a real estate stock, what's not. So just to name a few of the main categories of stocks that we can describe as real estate stocks, you have home builders. And just to give you a couple examples of each one, home builders would include companies like D.R. Horton, Lennar, NVR. Those are some home builders. Those are real estate stocks. Real estate investment trusts, which we're going to talk about in depth in the next few slides. It's not exclusively what we focus on here at Millionacres, but I'd have to say that about 2/3 of our coverage probably has to do with real estate investment trusts. They're a very important type of company. These are the companies that actually own real estate. So we'll go through some examples of real estate investment trusts, or REITs, over the next few slides. Mortgage lenders could be a big example. We've seen a lot of mortgage lenders go public lately and become publicly traded stocks. Rocket Mortgage is one big example. And The mortgage business has been booming over the past year, so it's not surprising that we're seeing a lot of companies come on the public markets. Real estate brokers. Um, I know Berkshire Hathaway has a big real estate brokerage business. There's also a company called Realogy that owns the brokers that you might be familiar with, called like Century 21. Um, there are real estate technology companies. We're seeing a lot more of these come onto the market lately. Big examples would include companies like Zillow, but we've seen a lot of kind of technology startups. Smart home companies would fall into that category. Um, Companies that do 3D maps of buildings would fall into that category. Um, and last on the list, we have real estate developers. Howard Hughes Corporation is one that's a personal favorite of mine. These are companies that develop land and develop buildings from scratch and kind of make their money that way. But there are a lot of companies that you could kind of call real estate adjacent businesses. Think of like Home Depot, not technically a real estate business, but tends to do well when the real estate market is strong. Um, there are a lot of companies we can call that. There's a lot of companies that own a lot of real estate but have other businesses. McDonald's is a great example of that. A lot of people don't know McDonald's makes a great amount of their money by building restaurants and leasing them to their franchisees. McDonald's is much more of a real estate company these days than a fast food company, I'd even go so far as to say. Macy's, the department store company, is another good example of that. Company that has a different business but owns a lot of real estate. So, like I said, big broad category of stocks that could be called real estate stocks. So, the one we're going to focus on for the rest of the webinar is called real estate investment trusts, which are pronounced REITs. Knowing how to pronounce that will already give you a leg up over a lot of people who don't invest in real estate stocks. So there's a special type of stock known as a real estate investment trust, or REIT. So just to go through a few of the basics of REITs. So there are two big categories of REITs. REITs either own commercial properties, which we call equity REITs. For example, an equity REIT might own a portfolio of apartment buildings. That will be known as an equity REIT. Some REITs own mortgages and related assets. We call them mortgage REITs. If you get a mortgage on your house, it might be bought or technically owned by a company called a mortgage REIT. These are companies that aim to profit from the interest rates that you pay on your mortgages. The general business model of a mortgage REIT, which I'll mention briefly because we're not going to talk about them too much more, is that they borrow money at short-term interest rates. You might know that short-term treasury yields are very low, for example. Short-term interest rates are lower than long-term ones. So these companies borrow money at low short-term rates, buy mortgages that pay higher interest rates than they're borrowing for, and they make a profit from the spread between the two. They use a lot of debt, a lot of hedges, a lot of different financing instruments to build their portfolios. And they are so different from equity REITs that they are actually not even in the real estate sector. Technically, mortgage REITs are classified as financial stocks, same sector that has banks and insurance companies. So that brings us to that third bullet point you see there. Usually when you hear the term REIT, we are going to be referring to equity REITs. If I'm ever talking about mortgage REITs in an article or something, I make sure to specify that this is a mortgage REIT. When we talk about REITs, we're generally referring to equity REITs. These are the companies that actually own buildings, own properties, own other assets that they lease out to tenants. So in order to be a REIT, a company must meet certain requirements. First, it needs to invest at least 75% of its assets in real estate or related assets and must derive at least 75% of its income from such assets. This doesn't necessarily mean it needs to own buildings. Real estate or related assets, that could mean it could own certain mortgage notes. Even equity REITs can own some mortgage debt, for example. Another example, one REIT that I like to cover a lot is called Outfront Media. They own billboard spaces, but they don't technically own the land that their structures are built on. They lease land, build structures, and then sublease it to tenants or sell advertising space to tenants. That's a related asset. So that would count for the purposes of being a REIT. So the key takeaway right there, 3/4 of its assets in real estate, 3/4 of its income from real estate. REITs can have some adjacent businesses, and a lot do. Um, One REIT that I follow operates a small streaming service, streaming video service. So they can have adjacent businesses as long as they don't make up more than 1/4 of their assets and income. A REIT must be structured as a corporation. A REIT is a type of corporation, so that's where that comes from. And a REIT has to have a minimum of 100 shareholders. This is why most REITs don't start out as REITs. Most REITs actually start out as smaller real estate partnerships. And that minimum of 100 shareholders is kind of a big obstacle to becoming a REIT. And no more than half of a REIT shares can be owned by any 5 shareholders. In the real world, most REITs limit ownership of any one individual to 10%, just to make this easy. Um, this is Berkshire Hathaway. Warren Buffett owns shares of one REIT called Store Capital, and Berkshire Hathaway has a stake of just under 10%, and that this rule is why. He'd probably own more if he could, but it doesn't work that way. And number 3, this is probably the most well-known characteristic of REITs. REITs must pay out at least 90% of their taxable income, which is why REITs make excellent dividend investments. The average REIT pays a dividend yield of about double what the average S&P 500 stock pays. And this last bullet point is why, because REITs are required to pay out at least 90% of their taxable income. Most pay all of it. There are several ways REITs measure income. Taxable income doesn't necessarily tell the full story. If you've ever heard that owning real estate has a lot of tax advantages, that's true on the corporate level as well. So there are a lot of tax deductions REITs get, so their taxable income is a lot lower than their actual income. But that last bullet point still results in above average dividend yields from most REITs. It's not uncommon to see REITs with dividend yields of 4%, 5%, or even more in some cases. Whereas most dividend stocks these days pay in the 2 to 3% range as far as large companies that pay dividends go. So why would a company want to go through all this trouble to become a REIT? Why not just incorporate and buy real estate, which companies can do? You don't have to be a REIT to own real estate. A lot of companies own big, like McDonald's could probably become a REIT if it wants to at this point. But it doesn't. But so why do companies that focus their business on real estate become REITs? So if a company meets all of those requirements I mentioned on the last slide, the REIT is treated as a pass-through business, just like if you owned, say, a convenience store, or if you owned your own business or of any kind. It's treated as a pass-through business. Income the business owns is passed through to its owners. That's significant in the corporate world because REITs avoid corporate taxes. So I'll give you an example of a stock that's not a REIT. Let's say Apple, which is a dividend-paying stock that is not a REIT. When Apple earns money, it's effectively taxed twice. Apple pays corporate taxes on its profits to the US government, and whatever local jurisdictions also charge them taxes. And they also, when they pay dividends to shareholders, those shareholders have to pay dividends on those corporate profits that were already taxed at the corporate level. REITs avoid this double taxation. They're only taxed on the individual level. And if you own REITs in a retirement account, like a traditional or Roth IRA, you can avoid taxes altogether. REIT income won't be taxed at all until you withdraw money from your retirement savings. So REITs have a lot of tax advantages, not only on the corporate level, but for the individuals as well. This is a very valuable competitive advantage that REITs have that can really help them compound long-term returns faster than other companies can. It always surprises people when I write about REITs that have 30-year track records of handily beating the stock market in seemingly boring businesses like self-storage REITs, or REITs that own big storage facilities, or REITs that own shopping malls or things like that. It's because they use these tax advantages combined with very favorable economics of commercial real estate in order to compound returns over long periods of time. There are some REITs that have returned over 100 times what investors put into them that have been around for like 40 years. Public Storage, if you know those big orange storage buildings, is one such REIT that has performed incredibly well over long periods. So why would you want to invest in REITs? Aren't real estate investments boring? This is one of the biggest kind of pushbacks I get because I'm a certified financial planner. When I tell people to put some of their money into REITs, they say, "Oh, that's boring. Why wouldn't I want to buy some of these tech stocks I'm reading about? Or why wouldn't I want to invest in, Apple or Facebook or Google or Netflix or, things like that?" And to be fair, the businesses themselves are boring. I can't think of a much more boring business than owning office buildings. But it can be a very lucrative way to invest over the long term. The returns are not boring. I mentioned Public Storage has returned an insane amount of money to early shareholders. There's some healthcare REITs and retail REITs even that have done the same. So real estate is considered a different investment class than stocks or bonds. The returns produced, real estate values don't tend to move in the same manner as the stock market. Real estate returns, such as the rent you can charge, doesn't necessarily move in the same pattern as the stock market. So not only that, there are less liquid assets, so they're much more. They're built for steady cash flows no matter what the economy is doing. So it can be a great asset class to hold during recessions as opposed to the stock market. So investing in REITs can be far easier than other types of real estate investing. So a REIT can be a lot easier than, say, buying a rental property. I own rental properties and I own REITs. The REITs are much, much easier to own, even with me doing the analysis myself, and with similar return potential. I need to crunch the numbers since I've started investing in actual real estate, but I'd have to imagine that the returns I'm getting from my REITs are pretty similar. So a lot less work, similar return potential. I mentioned REITs are considered a different asset class than stocks and bonds, even though they trade on the stock market. So it can add diversification to a portfolio of other stocks. If your passion is investing in tech stocks and biotechnology and things like that, that's great. REITs can help you add an element of diversification to protect against recessions and just general market movements. And finally, real estate has excellent long-term return potential. I mentioned a few specific cases. Over the past 100 years, commercial real estate as a whole has outperformed the S&P 500, and with far less volatility, meaning far less ups and downs along the way. So yes, the businesses themselves might be boring, but they're boring in the best way. They're boring in that they consistently produce strong returns and consistently let you sleep at night while they're doing it. So there are a bunch of different REIT subsectors that you can choose. Real estate is a broad sector of stocks, and REITs are the biggest component of it by far. Within the sector of real estate, you have a bunch of different subsectors. And just to name a few, I want to say there's about 14 different ones that are officially recognized. And I'll name a few examples of each one in case you're interested in doing a little more homework and looking into these. Residential REITs are real estate investment trusts that own things like apartment buildings and single-family homes. Avalon Bay Communities is one of the biggest ones in this sector. Ticker symbol is AVB. They own a bunch of urban apartment buildings in places like New York, Boston, San Francisco. Office REITs, companies that own office buildings. Boston Properties, BXP, is one of the biggest players in this space. As the name implies, these are companies that own office buildings. Most office REITs focus on urban areas, not suburban office space, but there are exceptions. Third, industrial REITs. Industrial REITs is a somewhat broad category. This includes companies that own things like warehouses, logistics centers, distribution centers. A lot of Amazon's distribution centers are owned by industrial REITs. Prologis is by far the biggest player in this space. Ticker symbol is PLD. Fourth, you have healthcare REITs. These are companies that can own hospitals, medical offices, senior housing facilities, life science buildings, like the ones that the COVID vaccines were developed in. A lot of those are owned by healthcare REITs. One of the biggest and oldest ones in the sector is called Welltower. Ticker symbol is WELL. They have been around for over 40 years and have been one of the best long-term REIT investments people can buy. I want to say they're one of the ones that have more than increased their original investors' money from the 1970s more than 100 times since the beginning. Self-storage REITs, public storage, ticker symbol PSA, is by far the largest player in this space. Most people in the United States live within a short drive of one of those big orange storage facilities. Most of those are owned by REITs. Hospitality REITs, most of these are hotel owners, but hospitality REITs can also mean things like movie theaters and restaurants and entertainment properties. But hotels are the big ones. One of the biggest hotel REITs is called Host Hotels and Resorts. Ticker symbol is HST. If you want to look into that, a lot of them own REITs that are operated under familiar brand names like Hilton and Marriott and things like that. These can be big winners of strong economies. Hotels, just kind of a little tidbit. While most forms of commercial real estate lease their properties out and measure in terms of years, like if you sign an apartment lease, you're going to sign a 1-year lease. If you lease office space, you might sign a 5 or 10-year lease. Hospitality REITs are the only ones that can release their space by the day. If demand is strong, hotels can increase their rent, or they can increase their room rates daily. So they're a really good one to benefit from strong economies. If you think the economy is going to strengthen, hospitality REITs might be one to look into. Retail REITs, a pretty broad category. This ranges things from shopping malls to freestanding buildings like drugstores to outdoor shopping centers. The first REIT I ever bought was a retail REIT. It's called Realty Income. Ticker symbol is just O, the letter O. It pays dividends monthly. They own freestanding retail properties. There's also a good example of a mall REIT is Simon Property Group. Ticker symbol SPG. They own, if you live near any malls under the Mills brand name. I know in North Carolina near me, we have Concord Mills. That's a Simon mall. At one point, Simon was the largest REIT of any kind in the market, until they were taken over by a few in the next category called the infrastructure REITs. Infrastructure REITs own things like cell towers are a big component of infrastructure REITs. American Tower, ticker symbol AMT, owns cell towers. Despite the name American Tower, they own cell towers all over the world, and are by far the biggest REIT of any kind in the market. So those are just a few examples of the different subsectors of REITs you can invest in. There are some that invest in more than one sector. They're called hybrid REITs. There are a few that have things like education properties and entertainment properties. There are some kind of specialty REITs. You have timberland REITs that own forest land that is used to make lumber and paper. If anyone's tried to buy wood at Home Depot lately, you know that this is a pretty interesting market right now. So the point is, there are REITs for pretty much every type of commercial real estate you could think of, and even some that you probably can't. So really broad category, really interesting opportunities, great long-term return potential. Don't think that these are just because you think the businesses themselves are a little on the boring side, that there isn't a big growth market here for well-run REITs. If you're not comfortable buying individual stocks or individual REITs, you can use mutual funds and ETFs to buy them as well. One big example is the Vanguard Real Estate ETF, which owns a portfolio of over 100 REITs. Ticker symbol for that is VNQ. VNQ. That's a good way to get some exposure to REITs if you want to just say use it as a diversification tool more than anything else. The mutual fund and ETF route could be the way to go for you. So with that, how do you find the best real estate stocks for you? Obviously, I can't teach you how to properly evaluate and analyze REITs in a few minutes. So sorry, but the best way to learn, you can learn all you can about REITs and how to analyze them on our homepage, www.millionacres.com. You can find my long form guide to an introduction to REITs and how to analyze them and things to look for and things like that. But learn all you can the best investors, I often say, just sit around and read all day. And it's to learn all you can. And, knowledge compounds over time. Or join us on our journey. We, like as Kevin mentioned, we have several premium services where we kind of do the legwork for you and find what we feel are some of the best picks. So far, the results have been very, very good. One of our services, our service, Real Estate Winners, has handily outperformed the market over time. So it's a really exciting time to be a real estate investor, and we hope you will consider joining us on our journey. And with that, I will turn it back over to Kevin.
Thank you, Matt. Much appreciated. And I know there was a few questions from some folks about some of the ticker symbols, et cetera. So what we'll do is we'll grab a couple of those from Matt after the session. And when we send out our follow-ups with the links to the recordings, we will include those in there. So we will stop the recording now. And